Free update on the economy relative to PMI indicators or ratings that were just released for September. Hello, I'm Rich Poston for Critical Points, October 1st, 12:15 p.m. Eastern Time. Okay, you're looking at a chart of the PMI. So first let me read off what occurred in PMI. For September, investors, traders, analysts, economists expected 59.5 for a PMI for September, and it came in 61.1, up 1.2 from the prior month. Good move, like it. It suggested that the economy actually sped up a little. Now, this is the manufacturing PMI, but I use it for the entire economy still, even though our economy has evolved to more services. We find the services tend to just lag what's going on in manufacturing, maybe lead at times. Not a big difference. All right, so we also heard on the sideline, the University of Michigan sentiment actually rose 1.8 to 72.8 when the trade had expected about 71. So sentiment improved a little bit. September and October, I believe, are normally a little more pessimistic times for investors, business people, people on the job, on the factory line, things like that. It has something to do with the change of seasons and light and fallout after all the summer fun, I guess, or vacation or something. And it is interesting how companies lay off into year end, even though we also should be preparing for Christmas. Okay. So at any rate, I'm pleased with this September performance. And this is an annual candlestick chart of the PMI. So it's showing the opening and current level of the rating, and then it's showing the high and low of this rating. And if you're not familiar with this rating or indicator, a rating above 50 basically means at least the economy for manufacturing is growing. And again, I just go ahead and say, hey, the economy is growing. And the higher it is above 50, the larger the number, the faster the pace of growth. So this economy is running full throttle compared to looking over prior decades, but not as fast as we go all the way back into the 50s. Okay. Now, this is one of the better performance than we saw during the 2010s under Obama and Trump, which, again, government is a little bit of an influence on our economy, but let's keep in mind most of GDP, like 90% of it, is consumer and businesses, and I still believe that government, Federal Reserve, Treasury, all that fun stuff basically adds to or takes away from the economy and perhaps some markets. They don't make or break the business cycle. You and I make or break the business cycle, okay? And currently, what's this indicator suggesting is, yes, we're on a fast-paced growth, but here's how it works. It normally is fast coming out of a recession because it's starting with such low numbers, and we're quick to try to rebuild our economy. This indicator will back off over the next several years as the economy continues to grow and continues to get larger, okay? And if I can think of it, I'll bring up a chart of real GDP that was released this week. But I will say real GDP is now at a record high, meaning the economy is record value or record amount, record size, whatever you want to call it. And I've been forecasting that since late last year when I thought the economy was bottoming for recession. So the recovery is over relative to GDP. First, we had to put the brakes on and get the maximum worst over for the recession. Then we had to move up out of the recession, and then we had to recover from the recession and recover back to where the economy was prior. We've done that, and we've now moved on to new highs. And I'm sure nominal GDP per capita, which used to be my favorite in that kind of economic analysis, is likely at a record high as well and runs a very positive correlation to how the economy grows in GDP and real GDP. Okay, anyway, looking good. But I just want to warn you, next year, it will not surprise me to see a dip because you can see about every third or fourth year we get dips out of this indicator. And so it will slow down on the indicator. But is the economy really slower? Are we actually losing? No, the economy is actually getting bigger. It's just not getting big as fast. And sometimes that's just a number game thing. It may still feel fast out on the street, out in the restaurants, out in the store. You have to bring this rating all the way back to 50 to get neutral, meaning the economy's not growing or contracting. Below 50, it means it's slowing down, it's contracting, you got issues. And at 45 or lower, you probably have a recession. However, my rule of thumb is I need 45 or lower, or maybe just a little above 40, to coincide with, this business cycle. All right. And if this business cycle, which I'm labeling 9-year, but we now also call it the juggler cycle in terms of the true macroeconomic cycle, and then in our price model, we'll use a similar cycle that we'll call a 9-year also, but we also call it an LT1 for the major long-term cycle. Any rate, basically this juggler cycle is suggesting, even though this indicator will back off for years to come, the economy is going to grow, until about 2028 to 2031, because that's what we do every decade. Throughout the history of this country, we can bridge it over into Europe, where we can see hundreds of years ago, the economy basically grew in that method, that style. And the stock market actually correlates very well, with that growth of the economy, better than ever, even though I realize a lot of you assume the stock market has nothing to do with economy fundamentals. There's always been a partial disconnect, and most of it's been lead or lag, and I don't doubt there's even a greater partial disconnect. But some things are actually even stronger correlated, a better connection. And one of it is with that juggler, macroeconomic or economy or whatever you want to call it, or business cycle. So don't be surprised this starts working lower in coming years. That's not a negative factor. Unemployment will continue to work lower. Employment will continue to work higher until we achieve full employment. And I'm not seeing a problem for the economy till near the end of this decade. I don't care what we throw at it. I got to be careful of that. Granted, there's going to be some disaster that I just can't see. Maybe a plague, worst pandemic, asteroid hits. But the point is, I don't see government, even though they screw things up, they're not going to screw it up enough. And even though we screw up things and cause complications and problems, and now we know nature can screw up things after the virus recession, we're really not seeing any of that. I think the worst problems are waiting to the end of this decade. And all that debt and all that money printing you think's negative, it's a positive. And guess what? For the entire history of this country, we've printed money. We were printing money the day this country was born. So don't keep talking about, the older generations and the founding fathers were smart. They didn't print money. BS. We've always printed money, and relative to the size of the economy back then, we also printed huge amounts of money. I've come to the conclusion after 30 years working with markets that free market capitalism and just capitalism in general always runs out of money eventually. It's just going to happen. There's going to be breakdowns, and you're going to have to print more, or the breakdown's going to be even more severe, and you could even wind up with social type revolutions and complications there, and decades of trying to pull yourself out of the gutter. So, in my opinion, we're probably always going to print money. And I don't see an interference, even though the U.S. Federal Reserve will pull back now a growing economy. Interest rates should rise. They should eventually raise their interest rates. They should eventually start tapering. We'll pull back that money printing. The economy is still going to at least kind of coast, if not move aggressively, for years to come. But there is trouble coming at the end of the decade. Now, this is a chart that I take the PMI and I simply tell this charting program, if PMI this in September was above 50, then add it to the prior month of this indicator. And if it's 50, do nothing. And if it's below 50, subtract it. And the interesting thing is, it does away with some of the smaller fluctuation that some may call noise, but my model says there's no such thing as noise. But at any rate, these are recessions. Here's a recession, bottom, boom, period. Recession, bottom. That was actually the financial crisis, Great Recession. Economic boom, recession, virus recession. Not as severe as the Great Recession. But that's because we printed a lot of money and went to work hard trying to get around it. And now we've got an economic boom, and this indicator is what runs a very positive correlation to nominal GDP per capita, and I assume with real GDP. All right, so it's basically saying, that this indicator's been saying the economy has actually been record large for quite some time now, and now we're seeing the GDP numbers actually catch up with that and saying the economy's record large. So there's going to be twists and turns along the way, throttle up, throttle down, complications. It's going to be bad news. It's going to sound sometimes like it's the end of the world. My guess, the economy is going to continue to grow to near the end of this decade, and the stock market's probably going to move right along, if not, rally at a fast pace even. We will see. Past results are not necessarily indicative of future results, but at the moment, I'm pleased with the September report here. We need to get over this debt ceiling stuff here in the U.S., and we need to move on. Looks like the economy is going to be growing for some time. Thank you.